Most investors did everything right. They chose their ETFs carefully, using a clear process. They avoided unnecessary complexity. They built a simple, well-diversified ETF portfolio, designed for European investors. And yet, their portfolio is down. That feels confusing. It feels frustrating. And for many investors, it feels like something must have gone wrong. Maybe the market was entered at the wrong time. Maybe geopolitical tensions created fear and uncertainty. Or maybe recession headlines triggered a broad sell-off. Or we may even have entered a new recession. For example, in April 2025, global markets dropped sharply after tariff-related fears resurfaced. Investors reacted quickly to uncertainty, and prices fell in a very short period of time. If your portfolio declined during that period, that does not mean your strategy failed. It means markets behaved exactly as they always do from time to time. Short-term declines are not a sign that investing stopped working. They are a normal part of investing. This is one of the most important things to understand. Markets do not move in a straight line. They move in cycles. Periods of growth are followed by periods of decline, uncertainty, and fear. And then, historically, recovery follows. Every major market decline in modern history has eventually been followed by a recovery. Some recoveries happen quickly, others take longer, but over long time horizons, markets have continued to move higher. This leads to an uncomfortable truth. The problem during market declines is rarely the portfolio. The problem is behavior. When prices fall, emotions become louder. Fear increases, doubt creeps in, and investors start questioning decisions that were perfectly reasonable only months earlier. This is where many long-term plans fail, not because the ETFs were bad, not because diversification stopped working, but because investors reacted emotionally to short-term noise. So what is the right response when markets fall? The correct response is not panic selling. It is not trying to time the bottom, and it is not abandoning a well-designed plan. The correct response is to stay invested. If you are investing for the long term, market declines are not a signal to stop. They are part of the journey. This is where dollar-cost averaging becomes especially valuable. When you invest a fixed amount every month, you remove decision-making from the process. You invest when prices are high. You invest when prices are low. You invest regardless of headlines. During market declines, those regular contributions buy more shares at lower prices. That improves long-term outcomes when markets eventually recover. And historically, markets do recover. Trying to wait for the right moment often backfires. The strongest market days frequently happen close to the worst days. Missing just a few of those strong recovery days can significantly reduce long-term returns. This is why staying invested matters more than predicting short-term movements. If you are young, or if you are investing with a 20 or 30-year time horizon, short-term declines are not something you need to fear. They are something your plan is designed to handle. A simple ETF portfolio combined with consistent investing is built for exactly these moments. It is designed to survive volatility. It is designed to reduce emotional stress. And it is designed to keep you invested when markets feel uncomfortable. Successful investing is not about avoiding all losses. That is impossible. It is about avoiding mistakes that cause you to quit. Staying invested during downturns is not about optimism. It is about discipline. If your portfolio is well diversified, low cost, and aligned with your long-term goals, temporary declines do not require action. They require patience. Over decades, patience has been rewarded. Short-term fear has not. In future videos, I'll continue breaking down practical investing topics step by step, with a focus on simple ETF strategies that work for European investors. If that's useful to you, you're welcome to subscribe. And if you know someone who is struggling with market volatility right now, sharing this video might help them stay the course.